Thank you for joining Market News with Rodney Lake. This is a regular program for the GW Investment Institute, where we talk about timely market topics. I'm Rodney Lake, the director of the GW Investment Institute. Let's get started. Welcome back to Market News with Rodney Lake. I'm your host, Rodney Lake. Remember, this is educational, entertainment purposes only podcast by the GW Investment Institute. Today we have a guest, a very special guest, coming back for round two for the Hinman Economic Report, also known as the KHER, our chief economist for the GW Investment Institute, Kathleen Hinman. Kathleen, welcome back to the podcast, and thanks for making time again to be on the podcast. As a reminder to everybody, GW Investment Institute podcast, educational, entertainment purposes only. Full disclaimers, double time here at the open. All right, welcome, Kathleen, and welcome back. So the first installment of the KHER report, we obviously talked about broad economic indicators and lots of things that are happening in the market. Where would you like to start today? What do you think is actually the most important topic at the moment globally?
I mean, I would say personally, I think it's definitely oil because the rise in prices with the closure of the Strait of Hormuz has really affected all of the economic indicators.
Absolutely. So obviously oil, I think many people would agree with that, and especially economists would say, look, this is driving a lot of other things. It's embedded into other products. And so I think it's important for people to think about and talk about. And certainly when you talk about inflation, we can talk about that too, that the oil prices are having a pretty dramatic impact. Could maybe just hit some of the top levels for us and, where we were last time versus maybe where we are now.
Yeah. So West Texas Intermediate, WTI, is the U.S. benchmark. Yep. And last month, it was actually at $64.51, and currently it is at $104.
Right.
So it has increased significantly, to say the least. And also Brent is now at $119 per barrel. So everything's increasing because, the Strait of Hormuz, actually 20% of the global oil supply passes through it. So
yeah, that's a very significant number. And a lot of people, say, okay, well, the U.S. is energy independent. And how does that impact us? But, oil and gas, natural gas is much more of a localized commodity, but oil for sure is a global commodity. So we feel these price increases like anybody else. There is a small differential, as you mentioned, the WTI versus the Brent, which is Brent's much more of an international benchmark. And what do you think? What's the flow through effect on some of these higher prices for oil prices? And we can get into whether you think that they're going to last or not, and I guess that's anybody's guess at the moment. But let's say, hypothetically, that they stay elevated at least for a little bit. What do you think the impact is on the economy?
Yeah, so definitely CPI, inflation is going to increase, which will lead to less consumer spending, especially with things like consumer discretionary. People aren't going to be buying, things like cars and stuff if they're having to watch their wallets. And not only that, with the rising price of transportation, it also increases manufacturing costs, which then makes all other products also increase in price.
So it increases the inflation level for effectively not everything, but many things, especially on the product side. So let's talk a little bit more about the oil business here, because obviously it is so important, and the war in Iran is obviously anybody's guess on when that might wrap up. And lots of people are hoping that it will wrap up sooner than later. But let's say it doesn't wrap up again as soon as people would like, which is, yesterday. What do you think is going to happen with the supply chain for oil? So oil, as you mentioned, 20% runs through the Strait of Hormuz, which is obviously challenged right now to get oil out of there for everybody. Can people reroute this? Is there alternatives, or is it really that's the only way to get that oil out of the Persian Gulf?
Currently Saudi Arabia and United Arab Emirates are kind of reallocating oil into pipelines. Mm-hmm. However, it's not significant enough for 20% of global oil supply. But so I think in the long term, there could be some reallocation of the supply chain. However, I think in the short term, it would take a while to really
make a big difference. Yeah. And as you mentioned, I think important context for everybody listening and watching on YouTube, thanks for watching on YouTube, is that we're talking, global oil production is about 100 million barrels a day. When you say 20%, that's 20 million barrels a day. So that's a very significant number. It's not like, you can just, come up with a pipeline overnight and say we're going to redirect 20% of global oil production. So these are really big numbers, as you mentioned, and 20% is obviously a huge portion of the overall global production and an absolute big number of 20 million barrels a day. So not insignificant, and certainly something that is formidable and a challenge to deal with here. Anything else on the oil price do you think that we should be thinking about? So as an investor, what are the kinds of things that we should be top of mind?
Well, I think it would be interesting to note just like the U.S. oil producers will gain more revenue from like kind of filling the supply gap.
Right.
So that's something to note. U.S. will likely increase oil production in the short term and maybe even go into reserves and things like that. So it would be probably beneficial to put your money into oil producers and things like that.
Not investment advice. But yeah, as you mentioned, as we talked about, rather, the U.S. is independent, for the most part, net exporter for oil and gas. And so our domestic producers here are likely to benefit from this. Now, consumers, as you mentioned, are not in the same situation. They're going to be paying these higher prices. Depends, maybe if they have an electric vehicle, they can skip that part, and possibly people might think about that if the elevated prices stay here for a while. But as you mentioned, something for us all to think about, and on the company front for evaluation, the domestic producers, again, not investment advice, like Exxon, Chevron, are likely to see some benefits of this in the short term. All right, let's shift gears now. Let's move on to the rates of business here. And so obviously the Fed, there's lots going on with the Fed, and they're looking to bring in a new chair. But for the moment, what are your thoughts about the Fed and Fed rates, and where do you think we are at the moment?
Yeah, so I mean, currently the target range is 3.5% to 3.75%. And at the beginning of March, the 2-year Treasury yield was actually at 3.82. So now it's actually outside the Fed funds rate. I mean, sorry, now it's outside the Fed funds rate. Originally, it was at 3.47 at the beginning of March. So it is interesting because we have this Fed funds rate, but I think it's just going to remain steady because of the the Fed looking at oil prices and inflation and having a watch for inflation. But they also are thinking that unemployment is going to stay the same at around 4.4%. So
yeah, as you mentioned here, there's a little bit of a push and a pull, or a give and a get, depending on how you want to say it. This balance between thinking about the dual mandate. Obviously, inflation is top of mind for them, but also full employment. And so when the Fed is thinking about that, at least what I've seen in the news, and love to hear your thoughts on this, where does that put the Fed for the rest of the year? Do you think that puts them just on pause? Do you think there's even talk now of, well, possibly if things continue this way, they might have to raise rates? And so that certainly discussion was not happening before oil prices shot up, as we talked about. So what's your thoughts? Do you think it just remains the same? Do you think that there's a higher likelihood of an increase, maybe above zero at this point? Or do you think we're on track for a couple of cuts? Or love to hear your views on that.
Yeah, so I think currently it's going to remain steady. I think it really depends on the Strait of Hormuz and if things open back up or not. If it long-term remains shut down, then I think eventually they might have to kind of adjust. They'd have to increase rates. And so it's definitely something to watch.
Right. Well, and it points back to that, I think nobody really knows what's going to happen with the oil price. So I think that's a big outlier consideration that people have to think about for what the Fed ends up doing. Maybe now talk about the jobs report and what's happening there. And certainly this is a closely watched number by the Fed, but closely watched by investors, business people, and analysts to really try to figure out, okay, well, what's happening in the market and what's happening with the economy. Love to hear your views on that.
Yeah, so I mean, the updated report hasn't come out just yet for March. However, we're expected to add 60,000 jobs. And as I said, the unemployment rate is thought to be the same, so 4.4%, which is still historically underneath the usual average. And so they do believe the labor pool is shrinking because of people retiring and things like that. So that's also partially affecting the unemployment rate being steady. So, yeah.
Yeah. As you mentioned, under 5% historically is considered full employment. And so, I think there's a lot of consternation about what's happening in the jobs market. But when you see unemployment at 4.4, that's certainly not historically alarming. And I think there's a lot to be made about the change and what's the rate of change and those sorts of numbers. However, if you look at the number, it's like, well, that's certainly not devastating and certainly drive us into some recession. One of the things that lots of people talk about now, and again, as our chief economist, want to hear your take on this, is AI and jobs. And so, one of the stats, and I might have mentioned this on one of the prior podcasts, and certainly the news has mentioned this, Block, the company, ticker is XYZ, not investment advice. In their last earnings call, you announced actually good earnings and profitability. And they announced, by the way, because of AI and the way that we're implementing this, we're going to let go of 40% of our workforce. They had 10,000 people. Now they're down to 6,000 people. So they let go of 4,000 people. And they attribute it effectively to, AI being able to do more work with less people. Do you think that is a one-off, an aberration? Do you think that this is something that is going to be consistently part of the framework? And do you think that that's a short-term phenomenon and that those people will get redeployed into other areas because AI is going to actually now create more jobs, but they're just not the jobs that we're thinking of, just, similar to other shifts in, industrial revolution and internet. And, certainly people didn't think in the internet days, okay, well, I'm going to be an app producer before, the app store. Nobody knew that job would exist, or an app developer. Your thoughts, curious on how do you think this is going to play out? And do you think it's really a short-term phenomenon that this reallocation will be messy or some other version of that?
So I think, for one, I think the tech industry, if you're in the tech industry right now, you might be a little bit in trouble. So, I mean, with just AI, like the technology has advanced so much that I feel like, 2 years ago, we were all saying everyone should know how to code. And now it's like,
now you should be an electrician.
Yeah, exactly. And that's another thing, though. I mean, I feel like, yes, there will be probably less jobs in tech. However, like the jobs, we actually went to a BlackRock's infrastructure summit who
Shout out
talked
to
about
Oscar
this recently.
Polito,
Yeah,
our alumni there who helped us get that invite.
Yeah,
great conference, as you
definitely
mentioned.
great conference. But yeah, what they were saying as well was that, jobs will change. So maybe you have less people in tech. However, we still need people like electricians and plumbers and HVAC and things like that to help build things in data centers and stuff like that. And we have such a lack of those currently.
Right.
So, I mean, the jobs will, I think, transition to different jobs kind of thing.
Right. So it seems like what you're saying is that in the short term, maybe if you're a software developer, a junior one, just getting started, you might be more at risk. However, over time, there's going to be opportunities in other areas, like being an electrician. Somebody has to wire up these data centers physically. It's certainly until the robots come and do that. We don't, I don't know how long that will be, but it seems like that will be more difficult in the short term to make that happen. Sticking with the AI piece here, when you talk about cybersecurity, and one of our episodes recently was about CrowdStrike, which is one of the holdings, again, not investment advice for the Investment Institute. Curious on your thoughts on AI and cybersecurity. Do you feel like that is an area where, if you listen to the news sometimes, and certainly the media, and I don't want to blame the media broadly, but you talk about Anthropic and OpenAI and Grok and Gemini basically wiping out all cybersecurity. Do you think that that's realistic, or do you think it's going to be some type of combination or something else?
I think it will be some type of combination. I don't think it's realistic that they're just going to wipe out cybersecurity. I think, especially with AI getting more and more advanced, you're going to need more advanced cybersecurity. So I think investors were kind of overreacting, because I did notice that, when Anthropic announced they can do cybersecurity and things like that, that the stock market kind of panicked on some of those companies. But I personally think that there will be more of a need for like advanced cybersecurity. There might be less people working at those places. However, I think it will still definitely be needed.
Yeah, and I think that's an important consideration as everybody tries to figure out, okay, well, what does that mean? Again, not investment advice, but from the perspective of the Investment Institute, one of the things that we're always challenging our students to think about in our classes who manage our funds is, what's the impact of this for the company? And so what does that mean for the underlying company? Certainly for the individual employee, it might mean there's a different mix of tasks that they have to do. If they do get to stick around, maybe they do get let go, maybe they can redeploy in some other area. But from the company perspective, does this mean that they have higher gross margins, or maybe they have lower gross margins, but they have a bigger total addressable market. Jensen Huang was recently talking about that, for example, and how some of these AI companies work out. So I do think as investors, it's really a big challenge for us all to think about is, okay, well, maybe the market cap grows, but actually maybe the multiples compress, but earnings grow by a lot. And so the overall market cap still grows because the TAM, total addressable market, grows by so much because you can do so many more things with fewer people, and you can do a lot more tasks with agents and everything else. All right. We may come back to the job situation. It's obviously an important topic. But for now, let's move on to GDP here. What are your thoughts on what's happening in the GDP?
Yeah, so I mean, last quarter, it was a 0.7% annualized growth, which was surprisingly low because it was 4.4% in quarter three. So that was a kind of a shocking difference. But the thing is, it's interesting. I feel like once again, it all has to do with the Strait of Hormuz and everything in the future, because I mean, considering it seems like consumer spending and investment was what was kind of driving the GDP growth would be kind of less if oil prices are still very high.
Certainly on the consumer side, higher oil prices could lead to lower, especially on the discretionary side. However, what's the data has been is that the consumer continues to be fairly resilient. It's very challenging to bet against the American consumer, by the way, because they love to spend money. And so I think that's a hard bet against the American consumer. It hasn't really worked out over time. All right, so let's move on. A couple more things here. So obviously the GDP is, we're all going to be looking for the new numbers coming out. But let's get into something that's obviously a big part of that, and that's housing. And certainly there's lots of talk about making it more affordable. But what do the numbers look like right now? What are the housing starts, and what's your outlook for housing in the U.S.?
Yeah, so privately owned housing starts in January actually increased at 7.2% above the revised December estimate. But what's interesting is permits have decreased. And between permits and housing starts, it's usually like a month and a half or so. So it seems to be that people are being more cautious, probably because of the higher mortgage rates and stuff like that. But it's also with the single family housing, there is a 2.8% decrease below the revised December figure. So, and then it's also decreasing for permits. It's actually down, I want to say 5.8% since January 2025.
Yeah, and that is curious. You would think, the spring season and, that's a normal time for people to be increasing get outside of the house, and the weather's a little bit better, especially in the northern hemisphere here in the U.S. That spring is a good time, especially Northeast and Mid-Atlantic, for people to be looking. You would think that, okay, that increase of, sort of historical, people looking around would translate into more starts, and permits rather. But it seems, at least right now, that's not the case. So I think that's something to watch closely. And I think you're exactly right. And I think lots of people say this too, that the interest rates being stubbornly high are keeping some people on the sidelines. And you keep all these people on the sidelines too for the turnover, because if you have a really cheap mortgage, you really have to have a good reason to move. And maybe it's not to move to the house down the street or house close by that maybe has one more room. It's going to have to be, oh, look, we need to we have a 1 bedroom, we need a 4 bedroom. And so something like that obviously might make you trade out of that situation. So I do think that the friction in the system, as you mentioned, is a little bit high because of those higher sustained mortgage rates at the moment. All right, so let's talk a little bit about the yield curve. And so speaking of interest rates and mortgage rates, what's the yield curve look like at the moment?
Yeah, as I said earlier, so it seemed that the beginning of March, it was 3.47 for the 2-year, and now it's at 3.82. And the 2-year is like a forward-looking indicator, so that means that people are expecting inflation, and that's why it's risen so much within March. It's very fast.
That is fast.
Yeah.
So we've covered a lot of territory, and obviously the focus has been for the U.S. and for the Investment Institute. The vast majority of the companies that we have are U.S. companies, but we do own some international companies that are ADRs, and some of those companies are Chinese companies. And so To wrap up here, I'd love to get your take on what's happening in China. The U.S. is obviously the biggest economy in the world, and China is the second largest economy. So these two are the powerhouses driving the global economy. So I do think it's important for us as investors, business people, and analysts to really take time to understand what's happening there. What are your thoughts on what's happening in the economic world in China?
Yeah, so China currently has a moderate 5% growth GDP, and it has very robust export growth. And then also the consumer price index shows low inflation, but of course, oil would also impact them. So,
Right.
yeah.
And any outlook for China? Obviously, China is I would say is the U.S. I would say we're number one, but China would probably say they're number one in AI. What are your thoughts about the overall economy and what's happening with AI as well?
I mean, they're definitely growing, and I think they're definitely advancing in AI as well. So, I mean, they're definitely one to watch.
Yeah, I think it's important for, again, investors, business people, analysts, and certainly that's what we tell our students in class. Look, China is the number two economy. They're number two in AI, and certainly they're head-to-head competition here with U.S. And I'm sure the people in China would say possibly they're number one in AI. But in any case, these two powerhouses are the places, if you're going to be an investor, business person, analyst, watching the global market, I think it's critical that you obviously pay attention to what's happening in the U.S., and I think it's critical that you pay attention to what's happening in China. So thank you for that. That is it for this installment of the Kaher Report. Thank you, Kathleen Hinman, for being on the show again, our chief economist for the GW Investment Institute, and we look forward to having you back again.
Thank you.
And that's a wrap for this episode of Market News with Rodney Lake. We'll see you back on the next episode. Thank you. Disclaimer, the content shared in the GW Investment Institute podcast is for informational and educational purposes only and should not be considered investment advice. The opinions expressed in this podcast are those of the host and guest and do not necessarily reflect the views of the GW Investment Institute or the George Washington University. Listeners should not act upon the information provided without seeking professional advice from a qualified financial advisor. Investing involves risks, including the loss of principal. The GW Investment Institute, the George Washington University, and the podcast hosts do not assume any responsibility for any investment decisions made based on the content of this podcast. Always conduct your own research and consult with a financial advisor before making any investment decisions.